Hello, welcome to the Webcast. I'm Angie, an IASB technical staff member. This is the third of a three-part series of webcasts to discuss some of the proposals related to the classification of financial instruments as financial liabilities or equity from the perspective of the issuer. When considering the scope of the FICE project, the IASB chose to clarify some of the underlying principles in IAS 32, the accounting standard dealing with the presentation of financial instruments, rather than making fundamental changes to address known practice issues. The accounting for obligations to purchase own equity instruments, applying paragraph 23 of IAS 32, is a long-standing practice issue. There have been several discussions at the IFRS Interpretations Committee and IASB meetings since 2006. All have ultimately referred the issues to be considered comprehensively in the FICE project. Common examples are forward purchase contracts and written put options on non-controlling interests. The current requirements of paragraph 23 are summarized on this slide. We will look at several questions that have arisen in practice over the years and the IASB's proposals in response to each question. Practice question 1 is about which component of equity to debit on initial recognition of the liability in the consolidated financial statements. For NCI puts, there is diversity in practice whether NCI or the parent's own equity should be debited. This would also affect whether to recognize dividends subsequently paid to NCI shareholders in profit or loss or in equity, and the accounting on expiry or settlement of the NCI put. The IASB is proposing to clarify that if the company does not yet have access to the rights and returns associated with ownership, the initial amount is removed from a component of equity other than non-controlling interest or issued share capital. By writing the put option, shareholders have been given an additional right, so there is no double counting of their ownership interests. Practice question 2 is about where the changes in the carrying amount of the financial liability are recognized when the NCI put is subsequently measured. Some stakeholders believe there is a conflict between IAS 32, which refers to IFRS 9 for subsequent measurement of the financial liability, and IFRS 10, which refers to equity transactions with owners in their capacity as owners. The IASB is proposing to clarify that remeasurement gains or losses are recognized in profit or loss, which is consistent with the requirements in both IAS 32 and IFRS 9 for financial liabilities. Only once the put option is exercised and the company's own equity instruments are reacquired will there be a transaction with owners in their capacity as owners. This is consistent with the description in IAS 1 for transactions with owners in their capacity as owners. Practice question 3 is about the subsequent measurement of the financial liability, specifically whether a company applies the IFRS 9 requirements for amortized cost or fair value accounting. The IASB is proposing to clarify that companies would use the same approach for initial and subsequent measurement to ensure greater consistency between the assumptions and inputs used. The liability is measured at the present value of the redemption amount. The redemption amount is discounted, assuming redemption will occur at the earliest possible redemption date specified in the contract. Therefore, the probability and estimated timing of the holder exercising the written put option is ignored. Because of this clarification, the IASB also proposes to remove the reference to IFRS 9 from paragraph 23 of IAS 32, as the measurement is neither amortized cost nor fair value. There are other measurement issues in practice, but these are outside the scope of this project. Practice question 4 is about the scope of paragraph 23 and whether it applies if an NCI put is settled with a variable number of parent shares instead of cash, because it only refers to settlement in cash or another financial asset. The IASB is proposing to clarify that paragraph 23 applies also to obligations to purchase own equity that could be settled in a variable number of another class of own equity. This is in line with the definition of a financial liability and using own shares as currency. Practice question 5 is about gross versus net presentation for gross physically settled forward purchase contracts and written put options. Gross presentation is consistent with accounting for puttable shares and obligations that are conditional on events beyond the company's control. Net presentation is consistent with accounting for derivatives. The IASB is not reconsidering gross versus net presentation, as that would be a fundamental change to IAS 32. But it is proposing to clarify the rationale for the gross basis, which is required by paragraph 23. Gross presentation, for example, would assist users of financial statements in assessing the company's exposure to liquidity risk. Lastly, practice question 6 is about the accounting on expiry of a written put option on a company's own equity. Paragraph 23 of IAS 32 requires the carrying amount of the financial liability to be removed from financial liabilities and included in equity, but does not specify where to recognize the credit to equity. Questions also arise about whether gains or losses previously recognized in profit or loss from remeasuring the financial liability can be reversed upon expiry of the put option. The IASB is proposing to clarify that on expiry of a written put option, the financial liability is included in the same component of equity as that from which it was removed on initial recognition. The cumulative amount in retained earnings related to remeasuring the financial liability could be transferred to another component of equity, but is not reversed in profit or loss. Thanks for listening to this webcast. Please submit your comment letters on our website before the 29th of March 2024. We look forward to hearing your views.